It's time to talk about the great Canadian business trap. Here is the unvarnished reality. One day you'll leave your business. But whether you walk away with generational wealth or just a deep sense of exhaustion depends entirely on what you're doing right now. Most business owners I speak with harbor a secret fear. They've built an incredible cash flowing machine, but they are the bottleneck. If they take a 4-week vacation, the machine stops. And when they look at their balance sheet, they realize they have no clear, tax-efficient way to extract their wealth. Today, I'm going to share a 3-step framework to fundamentally change how you think about your ultimate exit. Step 1 is conceptual, but critical. If your business relies entirely on you, it's worth exactly $0 to a sophisticated buyer. To maximize your exit price, you must systematize. Think about developing your own entrepreneurial operating system. You need a leadership team that executes without you. You need recurring revenue. You need to prove profitability. Adopting a profit-first methodology where you literally force the business to operate on its remaining cash after profit is secured makes your balance sheet bulletproof. Buyers pay premium multiples for predictable, owner-independent profit. If you're the ultimate technician in your business, you don't own a business. You own a high-liability job. We need to fix that. Step 2 is where most Canadian entrepreneurs accidentally shoot themselves in the foot. If you're planning to sell the shares you own of your business, you'll want to maximize the use of the lifetime capital gains exemption. This allows you to walk away with well over $1.2 million, completely tax-free for every member of your family. But to qualify, your corporation must be a qualified small business corporation. Here's the trap. If you've been highly successful and accumulated a massive amount of passive cash or portfolio investments inside your corporation, you might not qualify. The CRA demands that your corporate assets be used primarily in active business. Plus, if you generate too much passive income, you trigger the passive income grind, which aggressively claws back your small business deduction. You end up paying punitive tax rates. I call this a success tax, and it's completely avoidable. But to avoid it, you must strategically purify your corporation. You have to shelter that retained wealth in vehicles that the CRA respects, vehicles that don't trigger the passive income grind, but still compound your wealth predictably. Step 3 is optimizing your ultimate tax environment. Right now, the capital gains inclusion rate in Canada is at 50%. This means half of a capital gain is tax-free. But the smartest business owners, the ones who invest with the rigor of Warren Buffett, don't just settle for standard capital gains. They use advanced tax-exempt tools inside their corporation. One of the most powerful, yet misunderstood tools is Canadian corporate-owned wealth accumulation life insurance. It allows you to move surplus cash off your taxable balance sheet, grow it in a tax-sheltered environment, completely avoid the passive income grind, and ultimately pay out to your estate tax-free through the capital dividend account. It's the ultimate moat around your corporate wealth. You see, an exit isn't an event. It's a highly orchestrated process that takes forethought. You can't afford to figure it out on the fly. If you want to see exactly how these pieces fit together, how to organize your operations, purify your corporate tax structure, and shelter your wealth for an inevitable, highly profitable exit, I have something for you. I've put together a private client briefing that maps out exactly how successful business owners solve this puzzle. It's a deep dive into the exact process required to align your business, your taxes, and your personal wealth. Click the link in the description below to request your free copy of this private information. Begin with the end in mind, click the link, get the briefing, and take back control of your future.